How's everyone doing? I thought I'd do a live stream today, just commenting on so much that happened this past week. We had Jackson Hole with Powell essentially confirming that we'll get rate cuts in September. That's when we've got Nvidia earnings coming up on Wednesday. And I want to talk through those topics as well as some other themes that we're identifying here at Lumida. Every morning we go through and develop our views and refine them. It's wide and it's very deep. I want to share some of the highlights that we see there. I want to touch on AI and the US consumer as well. So first off, Jackson Hole. So look, in very widely expected speech where he reiterated Powell that wanted to cut rates. That's one. He opened the door to that in December of last year, where he said, look, the next move is going to be down. The market incorrectly thought that they would get rate cuts imminently. Did not have that view. For those that have been following us closely in our newsletter, we do think we get rate cuts this September. He didn't say we're going to actually get them, but we do think that happens. Now, we do believe that the market is and the economy is stronger than most people think. And in September, we're going to start seeing data from August. And we believe we're going to see a reversal in that non-farm payrolls report that caused so much anxiety together with this Japanese yen crash that created all this volatility that we saw on August 5th, 6th, 7th, that time frame, right? So for that reason, I think I'm in the 25 bips camp, not the 50 bips camp. I'm not even in the camp that we even need these rate cuts, by the way. So I'm going to talk a bit about that as well. Look, if you take a step back, we've got record earnings growth, right? Earnings came in stronger than analysts expected, like 12% earnings growth. Analysts expected 9%. One, we have record employment. Yes, the unemployment rate's going up. That's because the denominator, right? Unemployment rate's employment divided by the population seeking employment. The denominator went up because of immigration, okay, which is helping to combat inflation anyway, which helps the market too, right? We had 2 back-to-back months of retail sales exceeding expectations as well. So I don't see any recession here. And people are overly fixated on revisions to jobs data. You know what doesn't need revisions? Company earnings. You can look at company earnings and you can see what's happening with about a quarter lag, and they don't get revised, by and large, right? So we don't see that there. So certainly it's been our view that there's no recession here, and markets panic and they flip back and they're bullish now. So some of the things that we're seeing here, I wanted to share this study that I did. I published this online over the weekend. It was the last time we had adjustment cuts. So first off, let me make a distinction between like a full rate cut cycle and adjustment cuts. So a full rate cut cycle is when you have recession in the outlook, and the Fed wants to cut aggressively to offset that. They tilt towards the employment mandate rather than the inflation mandate because they're protecting against inflation because increases in unemployment are deflationary. So we had that in the 2007. We had that in the .com era. Those were full-blown easing cycles. And here we have an adjustment cut, meaning I expect that we'll get something like 2 to 3 25 bips cuts this year, and then the Fed will pause and wait and just not do much. So we had this in July of 2019, by the way. So if you recall, in 2018, there were some adjustment hikes, and the market panicked, and Powell swooped in for the rescue here. I'm going to pull up what happened in that 2019 period here so you can see the chart. But the headline is that markets finished the year in a melt up. And I believe we could be setting ourselves up for that kind of dynamic now. All right. I don't think it's going to be a straight line, but that is something that I think is quite possible. All right. So let's get this chart updated here. Just give me a moment here. Changes to 2018, and then this, I'm going to do 2019. Let's do towards the end of the year. Okay, great. So in 2018, there were these rate hikes. Markets corrected significantly, and there was some panic here. This was a deeper correction than we saw in August, by the way. It was relatively mild. It was just fast. And then you saw rate cuts in July of 2019, and markets tested a little bit here, and then they're off to the races. Now, if you look at how 2019 ended, I mean, this was a melt up, and it started with the onset of earnings season, which is around this date, around October 7th, October 8th, that kind of time frame. So, that would put us to around like here in this time frame, right? We're going to be approaching early September. There's some election cycle related volatility, maybe that happens around here. And that could be offset with positive data that we're reinterpreting from August, though. That reverses out some of the bad news we saw last month. But, I think that this could happen. Like if companies are growing earnings and they really don't need rate cuts, then it's adding fuel to the fire. So if my thesis on the economy is right, then, you could get something like that. Now, here's something else I wanted to point out for you all. So values beating growth. Now, this is a thesis we've had for a long time, and it's really come into focus with these rate cuts. First off, this is the growth index. This is IVW, S&P 500 growth ETF. The sector that gets whacked the hardest bounces the fastest. That's what happened here. So you can see in 2 days, you had a significant correction and, swoosh downward here, and you bounce back up, and now things are pulling back a bit. So let's take a look at value. So values all-time highs. Check that out. No one's talking about this, to my knowledge, right? People are talking about semiconductors and tech and all the rest, and you should have exposure there. But I think this is actually the real story. Now, what are the kinds of companies that you see here, right? Now, in tech, you're going to have Mag 7, you have semiconductors, you're going to have tech names. So here you have Berkshire Hathaway, you have the banks, JP Morgan, you have ExxonMobil. These are cyclical industries, certainly on the ExxonMobil. You have some consumer in here. Walmart reported well, healthcare, right? Home Depot, Costco. So I think we see more of that. I'm not saying it starts today, and I think this could pull back a bit. Be thoughtful about your tactics on how you get in, but I expect that more of that will happen. Take a look at this one. This is real estate sector. Okay. Now, real estate, because of commercial real estate and the rising rates, are supposed to be in a world of pain. What's happening here? This is all-time highs, actually, right? So maybe not all-time, 52-week high. Sorry. Okay. So real estate's had a melt up. The broader theme is that rate-sensitive categories are doing really well. Okay, because lower rates can allow these firms to potentially refinance. Okay, let's take a look at financials as well, right? Banks borrow short, lend long, also doing well. So this is at the highs as well. That's all-time highs, right? So that's the broader story that's playing out, and has to do with the anticipation of rate cuts, which is going to lead to this other thing we have, which is breadth expansion, right? So the breadth expansion is been really in effect the last 6 weeks, maybe 8 weeks or so. I think it's going to continue. And I expect that small caps will continue to benefit from this as well. In fact, we found this morning. If you look at the worst businesses, okay, really bad businesses. I want to own these businesses. Let me see. I have a list actually, these terrible, terrible businesses. Okay. These things really cranked. Look at the 5-day return on like Peloton, 50%, Redfin, BBAI. It's like a BS AI company. Beyond Meat is a Kathy Woodstock, in a deep bear market, right? A lot of these are actually in bear markets, by the way, but these are cranking. They have high debt to equity ratios. You can see here. This is a screen we built, and these are companies that may have trouble paying off their debt. We were looking for companies with bad balance sheets, and not all of these technically have bad balance sheets. And Aon will probably figure things out. I'm not too worried about them. It's a great business, but you get the general idea. Like you could think of this almost like a factor called bad balance sheets. And it cranked massively. Look at this. Like the return was like 5 points depending on how you measure it. And that's in 1 week. And most of that came on Friday, by the way. Most of that came on Friday. So I think it's a bit of an overreaction, but I wouldn't be surprised to see that continue into Q4 as well. Why wouldn't they, right? If there's a shot at refinancing, then these businesses, which are really call options, because they're either dead or alive, like Schrodinger's cat, and now they have the potential to refinance, they might be worth something. They could get bid up. Now, do they think these names are actually worth what the market caps are today? No, I wouldn't buy that. Now, this is a thesis I actually wrote about back in June 20th. So we're 2 months later. I said, hey, when we see rate cuts in sight, we will see the mother of all small cap rallies. We see the value rally. We see the breadth expansion. We also see small caps performing. Small caps did really well on Friday. And the other point I made here is that these small firms loaded with debt, they're hanging on their fingernails. That's what I just showed you on the prior screen. Okay. These are priced like call options, and they are really ramping right now. Commercial real estate, pick your worst businesses in the world. They're moving. So that's what we're seeing now. Like I don't think those are good investments because it's really like a one-off repricing. It's more like a trade. It probably rallies now through the year end. And then what do? Doesn't go anywhere, or maybe it corrects a bit into the next year. I don't think there's anything to do there if you're a long-term investor like we are. But I thought that was worth sharing. I thought that was very insightful into the dynamics that are happening underneath the market. So I'll go back to growth versus value. So as I mentioned, like when you have a correction, what gets hurt the most bounces back the most. That was the time to scoop up Nvidia and the best of growth in tech and semis. And we snapped up Nvidia. I wrote, I think it was 2 or 3 Sundays ago, we said, hey, when we look back, Nvidia's in the hundreds. That's going to be seen as a bargain. Nvidia now is set to report earnings after the market closed on Wednesday. And where's Nvidia today? It's 126. So I think that was the last great entry we're probably going to see for a while. Meta is at all-time highs. These are our picks, by the way, in growth. We have a tilt to value, but we think in growth, you want to stick to names like this. We own 1 or 2 other names also, but I posted another stat this weekend where Mag 7 generated the bulk of year-over-year earnings growth. So there's a reason why Mag 7 is outperforming the 493. They have earnings growth. It's got a legitimate basis. They're also indexed to the AI theme. So that said, I do believe that now that growth has kind of recovered, you saw the value versus growth, value is going to keep carrying. So a lot of things are going to go up. A lot of things are going to go up. That's one other headline message from this. I think you might, I write in this post, I think you might feel giddy at the year end. Now, it's not going to go up in a straight line. We've actually covered a lot of ground. I'm actually kind of tactically cautious where we are now. But take a look at this. This is a growth divided by value to try to look at regularly. Growth really cranked up quite a bit here. And I don't think we're going to exceed those levels. If you did, that'd be called a bubble. So I believe the baton's been handed over to value. And you'll notice that when that baton hands off, this thing doesn't look back. You might have these kind of snapback reversions here and there, but the broad trend is in sight. This is what makes this market very different than most. Something I've been writing about is that there's this hot ball of liquidity, and you can see it here. Look at that growth rally that we saw in a very short period of time, where we went from 1.6 to 2.2. That's a massive rally. It's like a 60, 70% rally at a broad aggregate basket level. It's a massive rally. You had that here too in 2020 to post-COVID up to the 2021 highs. You did not see this in the 2010s. This is a different market. And if you can be tactical and be nimble, I think there are more opportunities for you. You also have to make sure that you keep your head on your shoulders and you don't chase, because this probably reverts back towards value is my hypothesis. I think on Friday, probably a lot of people were chasing things that may give back some. Okay. Here's another great article. Actually, read this article. I got the headline. I've been tracking this story as well. They say a productivity boom is already here and set to accelerate. The New York Times, I guess, is becoming consensus now for the New York Times, right? So how AI can help start small businesses. Entrepreneurs say use of AI for a variety of tasks is accelerating the path to hiring and ideally profitability. What an amazing headline. All right. This is great. I've been tracking the productivity story for a while. Productivity rates are going up. The last time we saw productivity at these levels was in the mid-90s. That was an economic boom. That was a dot-com era where you also had technology improving productivity, the rise of the browser, the rise of email, of www.whatever.com. Okay. So that's a good story. That's a great story. And the reason why it's a great story is productivity is the one free lunch in economics. You can afford to raise wages and you can grow profits. Okay. And it's also disinflationary, which is also bullish, and it helps with the debt burden. This is a great story. And so it's hard to be bearish, right? From a long-term perspective, valuations are elevated. Yes, but earnings growth is delivering. And I don't see any reason why people are going to stop spending on GPUs, which is what the Mag 7 companies are doing. The other thing we see here is that there's ROI on AI. I think that is going to come faster than people think. There's a post I had over the weekend around developer productivity. And so far, most of AI gains have been around developers. But you are seeing firms like Amazon's AWS make more money and revitalizing those cloud businesses through the sale of AI cloud capabilities to customers. And obviously Nvidia is benefiting from that too, right? So, that's a good story. I think Microsoft's expensive, overpriced, all that's baked in. So you got to position carefully in those names. But I think the ROI for AI is better than most people think. And in Q4 or soon, we may see ChatGPT 5 come out. I have no idea if it's going to be good or not. But if it's good and expands use cases, that's bullish. If it's disappointing, then CapEx receivers, and meaning semiconductors, should still do well. But this is the stuff bubbles are made of, right? When people get a meme like, hey, AI productivity. But GPT-4 kicked off this cycle. When it was introduced at the end of 2022, it coincided with the end of a bear market. That's not the only reason things did well at the end of 2022, but it is a reason. And as I mentioned, it revitalized earnings for several mega cap companies, which drive the index weight. So here's some other observations. One, on the banks, there's a new thesis. I was speaking with a friend of mine who is a hedge fund manager, and he invests in just small banks. I called him up last week. I want to get a view on a name. He said, Ram, I have an idea for you. And this is his idea. I won't take credit for this one, but it makes a ton of sense. He says, I expect small banks to rally due to low rates, healing balance sheets. Well, I actually added that point in. He says, the bigger idea was lower rates will spark a bank M&A cycle. That makes a ton of sense. There's a lot of banks out there. There's 4,000 plus banks, many of them small community banks. Banks are going to want to bulk up on deposits. They're going to have more clarity as to which banks are naked, meaning upside down on CRE exposure. So I think owning quality small banks is actually a pretty good idea. Might be too early to go into that now. We saw XLF was all-time high. Now that XLF, those are mostly big banks. Let's take a look at KRE, which will have regional banks, smaller banks. Let's show that. So KRE has not broken out to all-time highs like the major, like the JP Morgans of the world. Okay, this is a rate-sensitive category, and also credit risk-sensitive category too. So, but that's a good theme. I think maybe in a few months there'll be some opportunities there. That means you got to start researching that now. What are the good banks? We own FCNCA. I'm not saying buy it now. I'm telling it to you because we already bought it and I don't intend to buy more of it. So it's got it's done pretty well. Actually, I could pull back a little bit here, but this has been a good bank. These are the guys that bought a Silicon Valley Bank and they got a special deal from the FDIC. I love those kinds of ideas. Same thing with UBS. We bought UBS for the same reason. They get these sweetheart deals from the regulators. This bank has outperformed the S&P over multiple decades, by the way, and 10.4 forward PE. I'm not trying to pitch you this idea. I'm just trying to share what we happen to own there. We own one other bank too, by the way. I'll share that some other time. So let's go back to some of these other ideas. So animal spirits are back. That's fairly obvious, I believe. You can see that in Bitcoin miners, Kava. Again, a lot of these gains happened last Friday. Okay. So on the consumer, I thought this is fairly interesting. By the way, I might have to jump around because we have a few topics that kind of touch upon each other. I'll do my best to try to coherently time together. These are live straight out of our morning CIO calls. It's a couple hours long, deep and wide. And if I'm able to, I'll do kind of flash insights on the spot. I'm trying to figure out how I can package that content. I'd love to get an AI to do a transcription and have like an AI influencer just like share that with people. You can ask questions, but give us like 6 months on that. So on the consumer, look, we saw Walmart did great, Target did great. So where's this death of the U.S. consumer? We don't see it. What's happening, we believe, is normalization of the economy and a shift in consumer preferences. People are spending less on travel and leisure. Well, after COVID, people want to stretch their legs. They want to go fly in planes again. They got on cruise ships. They had a bunch of meals at restaurants with their friends. Okay, now we're going back to 2019 behaviors. Cosmetics, Estee Lauder, those guys aren't doing too well. Department stores aren't doing too well. Online retail, Amazon's doing fine, right? So you're seeing these retail preferences shift. Oops, let me share my tab, sorry. Okay, so you can see this is from the Bank of America credit card spend report. Bank of America's got a ton of data on Visa, MasterCard spend because they're one of the largest card issuers. So I like to look at this periodically. And you can see that growth in online retail, right? E-com is still taking share away from non-e-com. That trend is still happening. And you see airlines and lodging, this travel and leisure and entertainment and restaurants pulling back, okay? Furniture has been in the dumps too, right? Because home sales have been down. I think decline in mortgage rates, which has led to a dramatic performance in home builders. Let's take a look at XHB. I think that could turn around the fortunes of that category, but it's probably too early right now. Okay, this is XHB. This is the home builders ETF. Okay, that is all-time high. Look at that. Why? Because mortgage rates are coming down. So the market's looking forward. The housing data is actually pretty terrible. Housing starts are terrible. Housing sales are low, but mortgage rates are coming down because the Fed is cutting rates or signaling they'll cut rates. So take a look at MHO. This has been our one and only home builder pick. And there's MHO. This green line is when I made a call on Twitter saying that you should buy it at this level, $115, $167 now. Didn't really go anywhere for a few months. We kind of felt stupid around here, by the way. Then in 2 weeks, 3 weeks, it takes off, corrects and goes again. That's Mr. Market for you, right? So you got to be pre-positioned in the right themes, be patient, buy good business at good prices. This is an 8.5 forward PE now. Still a lot cheaper than most of the home builders out there. And they're doing buybacks. So we like that. And they're also focused on the lower income segment, and they have their own special financing. They create their own mortgages for their clients, which is great. So they can get transactions done. Bear case is their backlog is shrinking, as is the case with many home builders. So you have to believe that these mortgage rates will come down. So some other highlights here. There's another consumer idea. I want to jump to that. Okay, yeah, actually on home builders, take a look. So home sales down significantly. MHO is up 5.7% on Friday, what I just showed you. And yeah, housing inventory is declining. Look, there's a housing shortage. Homes have to get built. So that's a subset of consumer discretionary, which has been very mixed. Depends on where you are in the consumer discretionary. Consumer discretionary includes home builders, includes airlines, which we saw are down, includes online retail, includes big box retailers like Walmart and Target, et cetera, includes Best Buy. This is a great summary conclusion. So consumers are spending on electronics, appliances, and auto. Auto, that's interesting. Okay. I'm actually not terribly excited about auto. I'll come back to that in a second, but less on apparel and sporting goods. Okay, well, let's take a look at a few different names here. One, we own GM. It's our only auto company that we own. I generally agree with Warren Buffett that you don't want to own auto companies. They're not the best business models in the world. I think GM is very different, though. It's done well. 4 PE is 5. We bought it when it was in the 4s. They announced 10 billion in buybacks back here, 6 billion here. They're growing earnings. They've got buybacks. They've got free cash flow. Okay, I like that. So GM, not at all-time highs, but let's give it a few weeks. I think it'll benefit from that value rotation. A bit overbought here, you can see, right? So let's see. What about Walmart and Target have been doing great, right? The Lululemons of the world and the Ultas of the world have not, right? So specialty retail has not. Okay, big box retail has. Now, look at this. This is Walmart. Walmart looks like it's performing like a growth stock. Right? How many of you own Walmart? I don't, but I respect people that do. Up 45% year to date. That rivals Meta. This beats most Mag 7. It's expensive. That's why I don't own it. I'm trying to find better ideas than Walmart. But yeah, look, that Walmart's been doing fine. And look at Target. Let's take a look at how Target's doing. Now, Target had some issues around shrinkage, by the way. And Walmart's lower cost, but they did have good earnings here that they reported. It's cheaper than Walmart, notably. Now, let me show you. This is really cool. I'm about to show you this internal tool we have. I've never shared this before publicly. Okay, but we have a bunch of cool internal technology. And so I want to learn more about the consumer. Okay, first off, I type in Walmart. I'm going to get the bull bear case on Walmart. Okay, this is not meant for an external consumption. UX isn't pretty. And we're iterating on this every day. Okay, so I get a story around Walmart, gets me the bull case, bear case, tells me the primary factors, and I can ask it questions. Okay, but what about like Target and some other names in here? Now, we've loaded the S&P 500 in here. We haven't loaded, I don't think Dick's Sporting Goods in here, for example. So it probably gives me an error. There we go. Okay. Walmart, Target, what other retailers you guys want to get a view on, right? So this has now loaded up all of these bull bear cases for each one of these names. And we've trained it on some proprietary data sets. I'm not going to share with you what those are. This is super cool, though. It just saves me so much time and our analysts a lot of time. So we can quickly identify where to focus. This is built on GPT-4o Mini. It's not the Brainiac LLM. We'll upgrade to that at some point. But now I can ask it questions like this. I can ask a question on an AI that's looking across all of these retail names, including their earnings transcripts, and say, what are the shifts in consumer behavior? Okay. Let's see what it says. I should have put in airlines in here. That'd be great if I track that as well, right? So it says increased online shopping. Well, we saw that, right? We saw online retail, that Bank of America report is going up. Focus on value. We saw the trade down to Walmart. How cool is this? Focus on health and wellness. So we missed that. Did not see that. Well, that's interesting. Maybe we should explore that. Experience over material goods. Yep. That makes sense. It's a common theme. Social media platforms play a significant role in shaping preference. That's interesting. All right. Okay. Share with me verbatim quotes from management supporting the ideas above and the social media point specifically. Okay. Let's take a look. I've never done this before. I have no idea what it's going to say. I'm really curious myself. But I love verbatims. Right now, we got to fix up the UX here. But so Lululemon, we see growth on our e-com channel. Target, social media continues to be a powerful platform for us. It shapes consumer preferences and leverages influencer marketing to drive purchasing decisions effectively. Health and wellness, that was Ulta. So yeah, this is pretty powerful, I think. And we want to get to the point where you can type in a ticker and you get an automated high quality report that combines qualitative analysis with quantitative analysis. That means like factors, valuation, earnings growth, is the theme performing or not? And then also competitive analysis, because these four players are competitors. Now they're positioned differently, they're going after different segments, we're all part of consumer spending. And some of those tides are rising, some of those tides are falling. Sometimes the whole tide is rising. In a recession, the whole tide is falling. But we think this is an incredibly powerful way where we can accelerate research and extract and generate insights fast. So how cool is that? I hope you guys had fun. I actually have to log off for a meeting now, but I see some Q&A that came in. Google 50% off high. Yeah, we bought Google on this whole antitrust news. I think it's like 4Ps around 19 or 20. The earnings growth is solid. We think they're going to be a winner in AI. I subscribed now recently, last week, to enable Google AI on my Google Workspace. It's really cool. So you should play around with that. You can have Google AI interact with your PowerPoints, your slides, not your PowerPoints, your Google Slides and Google Docs. And we have a 300-page chart book. I asked the AI, hey, find entries you think are interesting. And it came with some ideas. I'm not saying they were like the best ideas. They were good ideas, but it needs more training. And then the Google Doc, I had it update like an executive. So it actually gave me excellent feedback. I wrote an executive summary about Lumina for our investors, some VCs we're talking to, and it did a great job of that. It's all integrated into the app. So I like Google. I think especially with that growth to value rotation, right? You have less downside risk on Google and more upside versus say like a Microsoft. If GM is overbought, when's a good entry? Well, you know, when markets themselves are a good entry and you see this hit maybe like a lower moving average, let's say, I'll try to call it out if I see that opportunity in the future. Nvidia into earnings. I think Nvidia does really well with earnings. The market reaction, I have no idea. Now, take a look at what happened last year. I mean, last year, Nvidia didn't really go really much anywhere. The back half of the year, I'm kind of simplifying a bit. And then in the new year, it really got going. I don't know if that happens this year. You know, we own it. We like it. It's a top position. There was some news around delays in the shipment of Blackwell, which caused the stock, amongst other factors, to tank. We thought that was a buying opportunity. If you're buying an investment, a security, you're betting on a long-term stream of cash flows. Next month's delivery shipments don't drive the intrinsic value of the business. In fact, one of the things you learn in business school or you take the CFA, if you model out a cash flow stream, you discount it to get present value, you can delete next year's earnings and it has no material impact to the business valuation. So that was a gift. That was an opportunity. So good questions. And yeah, seasonality for September. So look, the positive seasonality around an election cycle just ends at end of August. So we're going to September. September, there are two things going on. One, it's generally negative seasonality. Number two, if the market expects 50 bips, I think the market will get 25. That's kind of more on the bearish side, but market might care maybe for like 2 days, let's say. On the other hand, I think expectations are coming in stronger than the market thought. I think economy is stronger than the market thought. And fundamentally, why that matters is because of earnings. So if we get 25 bips, well, that's because the economy is stronger than people thought. Remember, we've been in the higher for longer view, as you may know, since like early 2023. Now we expect rate cuts. So we said higher for longer is done. But stock market kept going up despite the fact that the market was disappointed by rates. Why? Because of earnings growth. And the earnings growth is there. We just had a strong quarter of earnings. So there's some mixed effects around September. We're still processing, developing our point of view on it. I think tactically we're a bit more cautious now. We think we ramped it quite a bit, and I think we'll get better entries within a few weeks or so. All right. So I hope that was fun. Be well now. Make it a great week. Take care.